$50 billion in profit. That is what ByteDance, the parent company of TikTok, earned in 2025, according to Bloomberg. While the United States government spent 2 years trying to ban TikTok, force a divestiture, and dismantle its algorithm, ByteDance quietly built the most profitable Chinese technology company in history. Revenue hit approximately $186 billion, up 20% year over year. The valuation has been marked as high as $480 billion by private investors. And TikTok Shop, the commerce arm that barely existed 3 years ago, doubled its Southeast Asian gross merchandise value to $45.6 billion in a single year. This is a company that was simultaneously fighting for survival in its largest Western market and building a commerce empire across Asia.
The contrast is incredible. How did ByteDance manage both of those things at the same time?
By running what I call a dual-track strategy. Track 1 was the U.S. legal and political battle. The Supreme Court upheld the ban law on January 17, 2025, in a unanimous decision. TikTok actually went dark in the United States for about 12 hours before Trump issued a 75-day stay. Then the negotiations began in earnest. On January 22, 2026, one day before Trump's deadline, TikTok finalized a deal to create a new American-majority entity. ByteDance retains a 19.9% stake. 3 managing investors, Silver Lake, Oracle, and MGX from Abu Dhabi, each took 15%. The remaining shares went to a group of other investors.
So ByteDance kept under 20%, which presumably avoids the foreign adversary-controlled classification.
That is the legal structure. Oracle serves multiple roles. It is a 15% equity owner, a board member, the technology infrastructure provider, the security monitor, and the data storage partner. All U.S. user data is now stored on Oracle Cloud. The algorithm that drives TikTok's content feed in the U.S. is being retrained exclusively on American user data, supervised by Oracle and an independent board. This builds on Project Texas, TikTok's multi-billion-dollar data security initiative that started in 2022, but goes significantly further by restructuring ownership and governance.
What did the $14 billion restructuring actually cost ByteDance?
ByteDance gave up majority control of its most important Western market in exchange for keeping it alive. The 19.9% stake is still enormously valuable. The U.S. TikTok business alone generates billions in advertising revenue annually, but ByteDance no longer controls the algorithm, the data, or the strategic direction of the U.S. entity. The ITIF published a detailed analysis titled 5 Takeaways from the TikTok Deal that characterized it as a structural compromise. ByteDance retains economic exposure but loses operational control.
Now, let's talk about Track 2, the Asian expansion, because the numbers are extraordinary.
While the U.S. deal was consuming political and legal attention, ByteDance was aggressively building TikTok Shop into the dominant commerce platform in Southeast Asia. TNG Global reported in February that TikTok's Southeast Asian GMV doubled year over year to $45.6 billion in 2025. That is not a typo, doubled. Indonesia was the largest market at $13.1 billion, accounting for 44%.
Let's unpack the dual-track strategy more, because I think the conventional framing has been TikTok is under threat in the U.S., but the real story might be that the U.S. was never the main event.
That is exactly the reframe I want to make. ByteDance is a Chinese company with $186 billion in revenue. The U.S. TikTok business, while important for advertising revenue, is only one part of the story. Douyin, TikTok's Chinese sibling app, is the core revenue engine. It has over 750 million daily active users in China and a fully integrated commerce ecosystem that is far more advanced than TikTok Shop in any international market. ByteDance's China business alone generates the vast majority of its profit.
So the $50 billion profit is mostly from China, not from TikTok US or TikTok Southeast Asia.
Correct. But the Southeast Asian expansion is the strategic growth story. China's domestic market is mature and intensely competitive. Alibaba, Pinduoduo, JD, Kuaishou are all fighting for market share. Southeast Asia, with 670 million people and rapidly growing digital economies, represents the next frontier. And ByteDance has a strategic advantage that no other Chinese tech company has in the region: TikTok. The app already has the users, the engagement, and the content creator ecosystem. Converting that engagement into commerce is the playbook they perfected with Douyin in China, and they are replicating it market by market across ASEAN.
The growth rate is what stands out to me. Doubling GMV in 1 year from roughly $23 billion to $45.6 billion is an extraordinary growth rate for a commerce platform. How is that sustainable?
It is sustainable as long as the core flywheel works. Users watch short videos, creators embed product links, users buy within the app, creators earn commissions. More creators join, more products get listed. The flywheel is self-reinforcing. What TikTok Shop did differently from Shopee and Lazada is that it did not try to build a traditional e-commerce marketplace. It built a content-driven commerce platform where the entertainment is the storefront. The live commerce format is particularly powerful in Southeast Asia. In Thailand, live selling sessions on TikTok can generate tens of thousands of dollars in sales per hour for individual creators.
Who is losing share to TikTok Shop?
Shopee is the primary competitor feeling the pressure. Sea Limited's stock price has been volatile as investors try to assess how much market share TikTok Shop is capturing. But interestingly, the overall e-commerce market in Southeast Asia is growing fast enough that both Shopee and TikTok Shop can grow simultaneously, at least for now. The estimated total addressable market is $150 billion and expanding. The competition becomes zero-sum only when market growth slows, and we are not there yet in most ASEAN markets.
Lazada is the other major player. Where does Alibaba's platform fit?
Lazada has been losing relative position. Alibaba has invested billions into Lazada over the past decade, but the platform has struggled to compete with Shopee's aggressive subsidies and TikTok Shop's engagement-driven model. Alibaba is now in a strategic review of its Southeast Asian commerce operations. There have been periodic reports about potential restructuring or divestiture. The irony is that Alibaba, the company that invented live commerce in China through Taobao Live, is being out-executed in Southeast Asia live commerce by ByteDance.
What about the regulatory angle in Southeast Asia? Because Indonesia temporarily banned TikTok Shop in late 2023 before the Tokopedia deal rescued it.
This is an important part of the story. In September 2023, Indonesia banned social commerce transactions on social media platforms, a rule that was widely interpreted as targeting TikTok Shop specifically. The government's concern was that TikTok Shop was undermining traditional retailers and small shop owners. Within months, ByteDance found the workaround, the Tokopedia acquisition. By buying into an established Indonesian e-commerce platform, ByteDance satisfied the regulatory requirement that commerce transactions happen on a dedicated commerce platform rather than a social media app. It was a brilliant regulatory arbitrage move that also gave ByteDance the logistics and payments infrastructure that Tokopedia had built over a decade.
So the ban actually accelerated ByteDance's integration into the Indonesian economy.
And gave them a deeper moat. Before the ban, TikTok Shop was a feature within TikTok. After the Tokopedia deal, ByteDance owns a significant piece of Indonesia's e-commerce infrastructure, warehouses, logistics networks, payment systems, seller tools. That is much harder for a future regulatory change to undo. ByteDance turned a regulatory threat into a strategic acquisition opportunity.
Let's talk about what the U.S. deal means for the global TikTok strategy. Contrarian corner. The consensus view is that ByteDance won. It survived the U.S. ban, kept 19.9% of the most valuable social media property in America, and built a commerce empire across Asia. That sounds like a victory. What is the skeptical read?
The contrarian position is that the U.S. deal actually weakened ByteDance's global competitive position in ways that the market has not fully priced. Here's the argument. The core of TikTok's competitive advantage has always been its algorithm, the recommendation engine that keeps users scrolling for hours. That algorithm was developed centrally by ByteDance, trained on global user data, and continuously improved using insights from both Douyin's Chinese user base and TikTok's international user base. The U.S. deal fundamentally breaks that loop.
Because the U.S. algorithm is now being retrained on U.S.-only data under Oracle supervision.
Exactly. The U.S. TikTok algorithm is now operationally separate from ByteDance's global algorithm infrastructure. It cannot use Chinese user behavior data to improve U.S. recommendations, and U.S. user data cannot flow back to improve Douyin or other ByteDance products. That means the U.S. algorithm will diverge over time from the global version. And here is the strategic implication. A divergent algorithm is a weaker algorithm. The power of ByteDance's recommendation engine came from the scale of its training data across multiple markets and languages. Splitting that into separate national or regional versions reduces the data advantage.
Does the same risk apply to Southeast Asia?
Not yet, but the precedent is set. If the European Union, India, or individual ASEAN countries demand similar data localization and algorithmic separation in the future, ByteDance could end up with multiple fragmented algorithm instances, one for the US, one for Europe, one for each major Asian market. Each instance would be weaker than the unified global version. The irony is that the US deal, while saving TikTok in America, may have established a template that other governments copy, gradually eroding ByteDance's core technical advantage.
That is a really interesting argument. What about the valuation implications?
ByteDance's private market valuation has risen to somewhere between $330 billion and $480 billion, depending on which investor's marks you use. That makes it one of the most valuable private companies in history. But here's the contrarian question. How much of that valuation depends on the assumption that TikTok's global algorithm remains a unified competitive advantage? If algorithmic fragmentation reduces the quality of recommendations in key markets, user engagement drops. If engagement drops, advertising revenue per user drops. If ad revenue drops, the commerce conversion rate drops.
The flywheel that drives TikTok Shop's $45.6 billion Southeast Asian GMV depends on the same algorithm that keeps users engaged enough to watch product videos and make impulse purchases.
So the commerce business is downstream of the algorithm quality.
Everything is downstream of the algorithm. That is ByteDance's fundamental insight and its fundamental vulnerability. Any regulatory action that degrades the algorithm, data localization, algorithmic transparency requirements, content moderation mandates, directly impacts the commerce business. And the US deal just demonstrated that governments can successfully force algorithmic separation when they have sufficient political will.
What about the competition from Shopee? Because C Limited is not standing still.
Shopee has a different but potentially more resilient model. Shopee is a marketplace. It does not depend on a single recommendation algorithm to the same degree. Shopee's competitive advantages are logistics infrastructure, seller tools, payment systems, and price subsidies. These are operational advantages that are harder to disrupt through regulatory action. If TikTok Shop's algorithm gets fragmented or degraded by regulatory requirements, Shopee's marketplace model looks relatively stronger. This is not a short-term risk. TikTok Shop is clearly winning on growth right now, but over a 5-year horizon, the question is whether ByteDance's algorithm-dependent commerce model is more vulnerable to regulatory fragmentation than Shopee's infrastructure-dependent model.
There is also the question of whether the US deal model gets replicated in Southeast Asia specifically.
Indonesia is the most likely candidate. The Indonesian government already demonstrated willingness to regulate TikTok's commerce activities when it banned social commerce in 2023. If Indonesian regulators demand data localization or algorithmic transparency for TikTok and Tokopedia, which is not impossible given the national sovereignty concerns we have discussed in previous episodes, ByteDance faces the same fragmentation risk in its most important Southeast Asian market. The Tokopedia acquisition gives ByteDance deeper roots in Indonesia, but it also gives the Indonesian government more leverage over ByteDance's operations, because now ByteDance owns critical domestic e-commerce infrastructure that cannot easily be moved offshore.
So the Tokopedia deal was both a defensive moat and a hostage.
That is a very precise way to put it. It is a moat against competitor entry and a hostage to government regulatory demands. The dual nature of that position is what makes ByteDance's Southeast Asian strategy simultaneously brilliant and fragile.
Action items. What should investors and business operators track here?
3 action items. First, track TikTok Shop's Southeast Asian GMV growth rate through 2026 as the single best indicator of whether ByteDance's commerce strategy is working. The doubling from $23 billion to $45.6 billion in 2025 set a high bar. Resource Data projects global TikTok Shop GMV reaching $112 billion in 2026, which implies roughly $70 to $80 billion from Southeast Asia alone. If TikTok Shop hits that trajectory, it confirms the commerce flywheel is self-sustaining and that ByteDance has successfully replicated the Douyin commerce model internationally. If growth decelerates sharply, say below 30%, it could indicate that the low average order values and thin margins of social commerce are hitting structural limits. Watch Indonesia and Thailand specifically, as they are the 2 largest and fastest growing markets.
Second,
monitor the U.S. TikTok entity's operational performance under the new joint venture structure as a leading indicator of algorithmic fragmentation risk. The deal closed on January 22nd, and the algorithm is being retrained on U.S.-only data. The metric to watch is user engagement, specifically average daily time spent on TikTok in the U.S. compared to pre-deal levels. If U.S. engagement drops measurably in 2026, it suggests the algorithm is performing worse without access to global training data, which would validate the fragmentation thesis. If engagement holds steady or increases, it suggests the algorithm is robust enough to work with localized data, which reduces the fragmentation risk for other markets. Oracle's quarterly earnings may also provide indirect signals. Oracle now has a significant revenue stream from TikTok's data infrastructure, and any commentary about the scale of that relationship would be informative.
third,
Watch for regulatory signals in Southeast Asia that could replicate the U.S. deal model. Specifically, monitor Indonesia's Ministry of Communication and Information Technology for any new regulations around data localization, algorithmic transparency, or foreign ownership of e-commerce platforms. The Tokopedia acquisition means ByteDance now operates under Indonesian corporate law as a significant domestic e-commerce operator, not just a foreign social media company. That changes the regulatory interface. Also watch Malaysia and Thailand, which are TikTok Shop's other major growth markets. If any ASEAN government moves toward requiring local algorithmic oversight or data sovereignty measures similar to the US CFI-US process, it would indicate that the US deal template is spreading, which is the single biggest long-term risk to ByteDance's global strategy.
The 3 signals are TikTok Shop's GMV growth as a commerce execution metric, US TikTok engagement as an algorithm fragmentation indicator, and ASEAN regulatory signals as a template replication risk.
And the overarching insight is that ByteDance's position is paradoxically strong and fragile at the same time. Strong because the financial numbers are extraordinary: $50 billion in profit, $186 billion in revenue, $45.6 billion in Southeast Asian commerce GMV. Fragile because everything depends on a single technical asset, the recommendation algorithm, that is now subject to regulatory fragmentation in its most important market and could face similar pressure in others.
The TikTok story is really a story about whether a global algorithm can survive in a world that is fragmenting into national and regional digital jurisdictions.
And whether the most profitable Chinese tech company in history can maintain its competitive advantage when the very governments it operates in are demanding that it break up the technical infrastructure that creates that advantage. That tension is not going away. It is intensifying. And TikTok's response to it will set the template for how every Chinese technology company navigates international expansion for the next decade.
And if you want the full written breakdown with the deal structure details, the GMV comparisons, and the regulatory risk analysis, it is in today's newsletter at asiatechmacro.substack.com.
In our next episode, we are looking at the Indian rupee and the Reserve Bank of India's balancing act, specifically how RBI's new governor is navigating between supporting growth, managing inflation, and preventing the rupee from breaching 88 to the dollar, all while India tries to attract the largest wave of foreign direct investment in its history. Monetary policy with geopolitical stakes.
That is going to be a rich topic.
Stay data-driven. Bye.